You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is financial consultant Richard Knowles of Knowles & Associates in Vancouver. Welcome to the show, Richard.
Thank you for having me, Jim.
As expected, the U.S. Federal Reserve Bank has maintained its predicted policy. It's ended quantitative easing, technically, although people have hinted they may bring it back. Richard, does that change anything as we expected or knew?
It was what we expected them to say, so it's not completely news. I didn't expect the markets to react too negatively, although they are selling off right now. So that has been what I've been waiting for a while, to see what they would do in this round before taking investor money and taking it off the sidelines as cash. To say, was this factored into the market? No, I don't think people really, many people are still surprised to see this. They actually expected to see the Fed come back going, no, the numbers are in. We don't think that it's time to stop it yet. But it's a very major factor. The money supply and the printing of money, which is what they've been doing and buying of treasury bonds, has been a very instrumental, absolutely major column of development to be able to support the current American economy. And indeed, they're factoring in the belief and actually acting on the belief that this is not going to be necessary moving forward. I think I'm making a call here, but I'm not sure. But I'm going to say next quarter, the next review, I think they may start it again. It may take a couple of quarters, but we'll see. It's very difficult to see right now whether the economy can indeed support itself and land on its feet. There are many pundits in the industry that believe that it can't, that the only reason the American people still have a decent, half-decent economy, if it's that, to what they used to have, is simply because the Federal Reserve has been printing enough money and supplying and buying enough of the debts out there to be able to support it. Well, I think that's up for debate, and now we're going to have a test of the system. Currently, the markets are not particularly happy. They are selling off in the States and certainly Canada. I mean, they were in positive territory. They're now in negative territory. Is that a direct relationship to this? Maybe not, but I believe it is. It seems to be almost a reactive, initial knee-jerk reaction to the situation. We'll see how it reacts for the rest of the week. If any more negative news happens in this quarter for the earnings, because this is the earnings period for third quarter for many companies, there's been mixed results depending on Facebook's off many dollars today because they haven't met their projections and expectations. There's a lot of negative news as well as some positive news. Depending on, it's going to be spot market, and I call this a wolf market. You have to go hunting. It's not just a bull or a bear, one way or the other. This is the hunting markets. And, we're seeing a lot of sideways motions. There has been a lot of negative moves since September and certainly since the highs in July and August. And we've just been seeing a lot of downward pressure, all around. And the QE stopping is in effect a downward pressure, momentum. Simply because we know that there won't be any more support coming from that avenue. And with all of that said, we'll have to see now what happens.
A wolf market, that's an interesting term. A lot of people are saying that right now we seem to be seeing corrections about every 3 months or so, and they say that's healthy because it gives you a chance to go and do some of that hunting. Is that the case?
Yeah, cyclical patterns like that are more of a technical point. What we're looking at right now is that we're combining what we call almost the triple witching hour. There's a great expression we have called the triple witching hour in the industry. But what we have now is a combination of events occurring at incremental times, or an instrumental time at this point in October. And here's what I mean by that. Typically, we see markets trade down in October for other reasons, other than something like a QE or elections, etc. But when we see a combination of effects, for example, we're in October now where we see a cyclical pattern in the year where we typically have a trading down in the third quarter, and there's a purpose for that and a reason. Most companies take write-offs in the third quarter so that it doesn't appear in their year-end results. And so their write-downs, they wait until the year goes by, then they take all their major write-downs in the third quarter that they've created so that it doesn't appear in their final results for the year-end. And consequently, the third quarter, typically you see some of the worst days. Today happens to be I think it's the 80th or 82nd anniversary. I don't know what year it was. It was 1929. But for the great market crash of the 1920s, for the created the Great Depression. So today is actually the anniversary, if you can call it that. That said, all the black days have always occurred in October. All the negative days have always occurred in October for various different reasons. We also have other combination events we watch for every year in this time. For example, is there a big election going on? Well, not a presidential or prime ministerial. We always look to the Americans for the big events. But we're not seeing any major events. But there's a Senate race right now in the United States. And that has been, that's a factor, whether Democrats or Republicans hold the Senate. That's an important factor for the American economy, which of course is a big partner to us, and we need to look, and globally for that matter. But that's a small event really in the big picture from an economic and financial standpoint. We look at all the geopolitical events to create technical problems during this time of the year because they tend to combine up for some reason in the fall. We don't know why. It just has happened like that over the evolution of our societies. And one of them right now is QE. This is a major event, pulling that off the table, pulling money off the table at the exact same time when we have third quarter. We have, it could put a lot of double whammy issues on this. And from a technical standpoint, as a technician, I'm looking at both fundamental basic stuff, geopolitical earnings, and I'm also looking at technical movements. Negatives, demographics, people are not comfortable, a lot of cash on the sidelines waiting to come in, but they want to wait till all this stuff settles. I'm saying stay out of the markets for now. Selectively look, hence the wolf market, selectively look for your good buys this time. You're never going to hit the bottom, I can guarantee that. You never know the exact lowest day of the year. But if you're going to try and fathom an area to be looking, technically speaking, October through to early November is a great time to start parking new money in. And other cyclical moments, Ides of March, March 15th through, maybe May, those are very volatile times. You've had big market movements happen between October to May. The reason you've heard the 3-month category is people look now every quarter. So we're looking quarterly earnings. And so you see a lot of movement every 3 months, just based on quarterly earnings. But the biggest movements happen in 2, maybe 3 times a year.
The U.S. Fed said it's cautiously optimistic about job growth, but critics point out the growth in jobs has been part-time jobs that pay little or service jobs that pay little. And really the job outlook isn't as optimistic as the Fed would make it to be. No, and we've been saying that for years, frankly. I mean, this has been a missed opportunity for the newscasters to really come clean. Nothing personal, of course, Jim. You're one of the most refreshing news organizations I've ever heard because of the honest reporting of information. Often we see that newscasters globally, Fox News, some of the bigger players, they tend to be controlled by their outlets, and their outlets are consequently typically aligned with some political agenda or some business agenda. And they can often wash down and water down the truth to make it easier and more palatable for people to sleep at night. There's the negative things going on, but you don't want to overplay that. But you find that so many of the news agencies also do that. They overplay the news because they want sensationalism rather than putting, a good example of that is the shootings in Ottawa. Clearly this man was an insane individual that had many mental problems and had been even extricated in Burnaby, the mosque that he had suddenly started attending. He wanted to convert to Islam. Well, of course, they invite him in and they want to help him along in his religious searching, in evolution. But then they realized that he himself was too radical, and they actually had him leave the mosque. They couldn't handle him, and they asked him not to to go to another mosque that may be able to help him out, but that their mosque couldn't handle it. And then he moves, and then he gets more radical, and he's got mental problems, and then he goes and has a shooting. So he's on his own quest. He's got his own problems. He wasn't sent by some radical movements, and yet the sensationalist news, CBC and others, are even buying into this whole idea. This is a terrorist attack. No, it's a crazy guy that went and shot somebody, and this can happen at any time. And then, they're downplaying the security levels at the Parliament. Well, I've visited the Parliament. I know people that are in Parliament, members of Parliament, and I've been to the inside and out, and I can tell you security there, while you may not see it, it's all over the place. You have no idea. And in fact, this guy was taken down, shot, caught,
was seen before he got in there. He outran the police, which can happen even in the White House. They had some guy running across the lawn somewhere. The greatest security in the world can't stop a radical guy from walking in and running in with a gun. So to bring it back to what we were talking about, when we see different kinds of information coming on employment, we have to really be very cautious. They're typically spinning it so that they can make more positive news sound more positive. Yes, there are jobs that are up, but don't fool yourself. This is the way it's been since 2008. The jobs improvement areas have all been in minor job areas, the types of jobs that we call McDonald's, frontline, burger pushers, rather than in quality areas of infrastructure, management, development, and technology and other major arts. In fact, those jobs, while they are expanding as well in biotech and in healthcare and in technology, it takes fewer people to do those jobs. It's more robotic because you're using computers to do many of the facilities that you once needed many people to do. Manufacturing jobs are moving. We just had, I believe it was Ford Canada, closed down, Ford Canada lost a contract to Mexico. So Ford is moving their manufacturing facilities because the Ontario government couldn't negotiate some sort of cheaper deal for Ford to continue manufacturing in Ontario. They've now moved to Mexico. So we're losing jobs. People are looking to make things cheaper, and it's a more difficult climate out there. But we're very competitive in Canada. We have standards here that help support us. And as long as we've got infrastructure and as an export nation, we have people buying our goods, we will feel it over time. But it's important to keep the news in order, and certainly in perspective.
We'll have more with Richard Knowles right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Richard Knowles of Knowles & Associates in Vancouver. Richard, was the goal of quantitative easing to lower interest rates, and have they met their goal, or do you think they had such a goal?
Yes, they've had that intended effect, but that was not necessarily the intent of the action of quantitative easing. What ends up happening is it's a process. Quantitative easing is really the buying back of financial instruments, debt instruments in the world, which puts more, and also printing more money to make the supply of money available. And therefore, by printing the money, they have access to cash that the federal governments have access. Well, it's the Federal Reserve. Hence, so to speak, the government, but really the Federal Reserve has access to cash that it prints itself, copious amounts of cash, I might add, to use without having to borrow it. They're really just taking the money, and therefore there's more money supply out there, and then they use that money to buy back debt instruments in the world to support the debt payments that the U.S. is making around the world. Remember, they pay $1 trillion. They're multi-trillion dollars in debt to the world. The rest of the world, they owe the rest of the world trillions and trillions of dollars. I don't know what the current number is, 300 trillion something. Some ridiculously large figure at the moment. I'm sure we could all look it up in about a second on Google. But at the end of the day, what we have is payments that are in excess of $1 trillion a year, just in the debt interest payments. So consequently, one of the key features of quantitative easing is making sure that we control the debt payment. They control the debt payments, et cetera, that go on. It's a very complicated process. It's not like, well, we're going to do this to drop interest rates. Interest rates dropping are an effect of the quantitative easing process. Quantitative easing process is not created for the purpose of dropping interest rates. It's really created for the purpose of controlling debt payments and to make money supply more readily available. Then the effect of that is to drop interest rates because lending becomes more easily available with cash flush being paid to the banks. The banks now have more cash to lend, and they're being given the modus operandi to drop their interest rates to make lending more easily available. So it's a bit of a competitive marketplace for the interest rate market. Some will, some won't, but typically they drive down their rates along with the dropping ease of access of cash at virtually no cost to the banks to get this money. And they get the money directly from the government. They're printing up a bunch of money. They basically give it to the banks to lend out to other people. It's a process. It's a large process that has different purposes for being brought into play. And one of the net effects of that is dropping interest rates. And in so doing, it makes borrowing, if you will, money much more affordable. And the net effect, of course, by making money supply more available is that we hope, the Federal Reserve and the central banks hope that money will end up in the hands of the businesses that will help to generate more and develop more employment. Consequently, also, more money ends up in the hands of consumers who would be paid more, in theory, with more jobs. There should be a growing economy, and the salary should increase. Now, this is all economic theory. Now, what we have to realize is economic theory is not economic fact. There are many theories about how to supply support to an ailing economy to help support it so that it stops being sick and it gets on with its being healthy. There's many theories on that. Some are opposing views in the theoretical economics world. However, the actual practical applications are never exactly cut and dried because every nuance of difference in the economy will affect it differently. So what we're finding is that the activities of quantitative easing of this level has never been done before, except in post-World War era. When the World War devastated economies, the printing of money was the solution to get out. Now that, of course, erodes the value of each dollar you print. And so we had the devaluation of currencies, which occurred with massive printing, but it was the only way to get Germany back on its feet. It was the only way to get the U.S. back on its feet after these tremendous wars. Now, there's other things going on there. There were many corporations making money, especially the military manufacturers during the war. They weren't whining. They didn't put in more money into the economy to help to resubstantially put it into play. This is when corporate takeovers of many political agendas were done, et cetera, et cetera. There's great stories on this. I invite all your listeners to get the books out on this because this is fantastic. The truth is far more amazing to read than fiction. If you like anything, many mystery novels, boy, you're really going to love this stuff. But at the end, and I'd be happy to answer any of your readers' questions of which books to read, by the way. You can send it on an email anyway. But at the end of the day, quantitative easing has a process. We see that process played out, but we're never exactly sure how it's going to play out because the economy reacts differently to it in every single cycle that some solution may be thrown out. So we really have not done this before, certainly not to this extent and for this long. So this is a new experiment in economics to see what's going to happen. That's why they're very reticent to pull it off the table too quickly, because they don't know what effect we're going to see over the next quarter, 2 quarters, on not creating this money supply. Is the economy really enough to stand on its own? And this will be a very big test over the next quarter.
Richard, thanks a lot for chatting with us.
Thank you. Thank you for your time.
My guest has been financial consultant Richard Knowles. You can contact Richard at Richard K, that's the letter K, at customplanfinancial.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.